Hi, welcome back. It's August 15, 2019, and right now financial markets are grappling with growing fears of slowing global economic growth and rising recessionary risk here in the U.S. Yesterday, the Dow Jones Index was rocked. It dropped 800 points, and all the major U.S. stock market averages were off 3%. The catalyst for yesterday's sell-off was the news that the Treasury bond yield curve has now inverted. Now, in normal conditions, long-term Treasury bonds carry a higher yield than short-term bonds. But recently, investors have put such a high premium on owning long-term bonds as a protection against possible future economic uncertainty and slowing growth that the prices of those bonds have gone higher and higher, and yields move the opposite direction, lower and lower and lower, until the point that we reached yesterday, where the yield on those bonds are now below that on two-year treasuries. Now, this yield curve inversion dynamic is a very important factor to pay attention to because it has preceded every recession that we've experienced here in the U.S. at least since the 1950s. But folks, this is not a sign that a recession is right around the corner because the average lead time between the inversion occurrence and the actual recession start has been about 17 months. So we still got some time. Also, it's important to understand that the yield curve inversion is not a gauge of economic health. Rather, it's a reflection of investor fear about economic weakness. For a recession to occur, we need to have two back-to-back quarters of negative economic growth. Now, the last quarter, our economy grew by 2.1%. That's positive, not negative yet. We're expanding still and not contracting. It's also important to realize that the dynamic of this inversion may be quite different from what we've experienced in the past. As our former Fed chair, Janet Yellen, pointed out, we today have a very unique dynamic historically of having $15 trillion around the globe of government bonds yielding below zero. So while our 30-year U.S. Treasury bond is yielding an all-time low of just 2%, that's pretty attractive compared to most of the rest of the world. Investors demanding to own those bonds could push the yields even lower and lower without actually signaling that a recession is on the horizon. Also, we cannot discount the ability for President Trump to quickly change the direction of this market. His future success and possible re-election as a president is very closely tied to what's going on with the economy and the stock market as a reflection of that. In fact, he's touted the stock market's recent all-time high as a reflection of his policy success. Probably more than any other president in history, he's focused on what's going on in the financial markets. He could easily send out a tweet or change policy direction quickly that would move the market back in a different direction. Be very focused on the possible opportunity for President Trump to end the trade war with China, which would quickly change the direction of this market and move it back in the right direction. Again, it's in times like this that we're reminded why we have to diversify in our portfolios and why we include in our client portfolios exposure to treasuries, gold, and money market instruments as hedges or safe havens against volatile periods like this. And we include them and today own them quite significantly in our global allocation models. Thanks again for watching. Please stay tuned because I'm going to continue to cover several indicators of recessionary risk that we have to pay attention to get a sense of what's going on right now and to make sure that you are feeling comfortable about your own financial situation. Thanks for watching.